Time is a friend of wonderful businesses, but an enemy of mediocre ones. Warren Buffett. Have you ever stopped to think about how the world of investments is preparing for the challenges and opportunities of 2025? Buffett, the legendary investor and CEO of Berkshire Hathaway, continues to amaze us with his strategic vision, even in a constantly shifting global landscape. Known for his ability to identify value where few can see it, he reinforces an essential lesson: patience and a focus on solid fundamentals are powerful weapons for facing uncertainties. With fluctuating inflation, technological advancements, and geopolitical tensions reshaping markets, many investors are eager to discover what 2025 holds. But while most worry about short-term trends, Warren keeps his gaze fixed on the horizon, betting on strategies that withstand the test of time. Why is he heavily investing in Japanese companies? What's the logic behind his recent acquisitions in technology and essential services? And how does he continue to influence the future, both in markets and philanthropy? Throughout this video, you'll uncover his latest plans and how his approach can offer valuable lessons for your own financial journey. We'll explore the strategic decisions of the Oracle of Omaha, understand his predictions for 2025, and most importantly, learn how to apply his wisdom to our lives. After all, as Warren likes to say, be fearful when others are greedy, and greedy when others are fearful. If you're looking for clarity, inspiration, and proven strategies for the future, this is the right place. Get ready to understand what drives one of the greatest investors of all time and how these principles can shape your financial vision. Let's dive into his mind together. Stay until the end, because these lessons might forever change the way you view investments. When we think of Buffett, one of the first things that comes to mind is his insistence on investing in the intrinsic value of companies. He believes that the essence of financial success lies in choosing solid and sustainable businesses, ignoring market noise, and maintaining a long-term perspective. In 2025, this philosophy remains more relevant than ever, especially during times of economic uncertainty and rapid technological transformation. Warren teaches us that before investing in any company, we need to ask ourselves three fundamental questions. Does the company have durable competitive advantages? Is its business model understandable and predictable? Is it being traded at a reasonable price relative to its intrinsic value? These principles are evident in his recent decisions, such as his increased investments in Japanese companies. Mitsubishi, Mitsui, and other major corporations attracted Buffett because of their diversified operations, robust balance sheets, and consistent dividend policies. They exemplify what he calls economic castles with wide moats, that is, companies protected by competitive barriers that are difficult to breach. Another central point in his strategy is his aversion to unnecessary complexity. He often says that if he doesn't understand a company's business model, he prefers to stay out. This explains why he frequently opts for stocks in sectors like consumer goods, energy, and banking, areas where predictability and resilience are stronger. A classic example is his confidence in the Coca-Cola Company, in which he has been a shareholder for decades. The reasoning is simple: people will continue to drink soda regardless of market trends. If you apply this logic to your own financial life, you'll find you can avoid many mistakes. Before investing, ask yourself, do I truly understand how this company generates profit? And can it remain profitable in the future? Answering these questions honestly can save you from rash decisions. Warren often compares investing to planting trees. Someone is sitting in the shade today because someone planted a tree a long time ago. He believes that financial success is tied to patience and the ability to ignore abrupt market movements. A brilliant example of this was his decision not to sell stocks during the 2008 crisis, when many panicked. Instead, he took the opportunity to buy undervalued stocks, such as Goldman Sachs, reaping extraordinary rewards in the following years. In 2025, many markets may present similar opportunities. If fear dominates less experienced investors, stocks of well-managed companies with strong fundamentals might be traded at low prices. Those who can identify these opportunities, staying calm during moments of crisis, will be in a position to benefit in the long term. One of his maxims is that what you decide not to do is as important as what you do. He is famous for avoiding tech stocks for much of his career, simply because he felt he lacked the ability to understand the sector. Only in recent years, with the absolute dominance of giants like Apple, did Buffett decide to allocate capital to this segment. His patience in waiting for the right moment was rewarded, with Apple becoming one of the largest positions in Berkshire Hathaway's portfolio. If you want to learn from Warren, remember that avoiding bad decisions is as important as making good ones. This includes avoiding speculation, which can be extremely tempting, especially in heated markets. Never buy something just because everyone else is buying. One of his most iconic strategies is identifying undervalued stocks, those that the market temporarily ignores or neglects. For him, the secret is not in following short-term trends, but in calculating a company's intrinsic value and comparing it to its current stock price. When he finds a significant discrepancy, Buffett acts decisively, buying with confidence. He uses a simple yet powerful approach, calculating a company's discounted cash flow, projecting its future earnings, and bringing them to present value. It's like buying a property with the certainty that the rent will generate robust returns in the future. This philosophy was fundamental in his decision to invest heavily in Apple, even after years of avoiding the technology sector. He realized that Apple had transcended the label of a tech company and become an indispensable brand for consumers worldwide with stable and growing cash flows. Warren is a master at turning crises into opportunities. During the 2008 financial collapse, while many investors fled the market, he acquired significant stakes in companies like Goldman Sachs and Bank of America. His logic was clear. Companies with solid fundamentals can weather crises and emerge even stronger. This mindset is rooted in another of his principles. The stock market is a device for transferring money from the impatient to the patient. In 2025, with a potentially volatile economic environment, patience and the ability to withstand fear will be more important than ever. He reminds us that the best time to invest is often when everyone else is pessimistic. If you are planning to take advantage of a potential market downturn, follow his example. Focus on companies with strong competitive advantages. Ensure they have the capacity to endure difficult periods. Make sure they are being traded at prices that provide a margin of safety. One of Buffett's most admirable qualities is his consistency. He remains true to his principles, regardless of what is happening in the market. This discipline is what sets successful investors apart from those who make impulsive decisions. For example, while many investors try to guess the next big sector or trend, Warren continues to invest in companies with proven business models. He believes a good investor doesn't need to be a genius to succeed, but must be consistent and disciplined. This practical approach is something any investor can apply. You don't need to be a financial expert to choose good investments. If you're unsure about which stock to buy, he recommends starting with low-cost index funds, such as those tracking the S&P 500. These provide diversified market exposure and eliminate the risk of picking the wrong individual stocks. Another central point in his philosophy is his long-term perspective. He often compares buying stocks to becoming a partner in a business. When you invest, you should think like an entrepreneur. If I owned this company, would I be satisfied with its performance 10 years from now? This simple question helps avoid impulsive decisions and guides the choice of companies that create sustainable value. This mindset is reflected in his investments in Coca-Cola and American Express, which he has held for decades. Buffett knows these companies have resilient business models, strong brands, and a proven track record of adapting to market changes. Warren also teaches us that investment success doesn't just depend on knowing what to buy, but also on knowing what not to buy. In heated markets, where euphoria can drive stock prices to irrational levels, he prefers to keep capital reserved rather than invest recklessly. This prudent approach was evident in 2020 when he avoided the overhyped investments during the peak of the tech startup boom. Instead, he patiently waited for better opportunities, keeping billions of dollars in cash. His patience was rewarded when the markets adjusted, allowing him to make strategic purchases at lower prices. Buffett teaches us that success isn't just about money, but about living a life of purpose and continuous learning. He says, the most important thing to do if you find yourself in a hole is to stop digging. This advice applies not only to investments, but to all areas of life. Recognize where you can improve, adjust your course, and keep moving forward. If you truly want to achieve financial success, start today. Adopt a disciplined approach, focus on the long term, and remember that the greatest results will come to those who invest with patience and intelligence. As Warren has proven over decades, you don't need to be the fastest or the smartest, but rather the most consistent. If you enjoyed these lessons and want to learn more about achieving financial success inspired by great investors, don't forget to like this video and subscribe to the channel. That way, you won't miss any content that can transform your perspective on finances and investments. See you in the next video.